Okay, so this is what's called a yield curve. If you've heard that in the news, this is just showing you what different interest rates are on US Treasuries at 3 months, 2 years, if you loan money to the government at 20 years or 30 years. And usually you get paid more the further out you go. And over here on the right, what you see here is the stock market, the S&P 500 index over time. And what this tool on stock charts does is called the dynamic yield curve. This allows us to see what was the yield curve looking like back in time. So you can go back in January of 1999, and you can see it was still pretty upward moving, although rates were higher now. But what gets kind of interesting is when you start looking at peaks like August of 2000, it seems to go backwards. They call that an inverted yield curve. And what some of the analysts tend to pay a lot of attention to is 2 year versus the 10 year. And when that's higher, the reason they key in on that is because historically, like back in 2000, that's happened near market peaks in the stock market. And then what usually happens is we'll go into a recession or a bear market and rates will fall. The Fed's controlling this end of the yield curve. They lower those rates and steepen that yield curve, and they think that stimulates the economy. And you know what? It tends to do so. But then you can go back here again in 2006, it starts getting a little bit more flat to inverted. And then we had the 2007 and 2008 mortgage crisis, and then it got steep again. So where are we today? Well, earlier this year, things were getting pretty flat, and we saw the short-term rates get a little inverted. But where we are at the moment is still really low rates, but generally you're getting paid normally. You're getting paid for going a little bit further out, although not much. So that's a little primer on interest rates. Have a great day, everybody.